How many ETFs or stocks should I own in my portfolio? When you first start investing, you inevitably go one of two ways. You either start buying a bunch of individual stocks because the more you research or hear on YouTube, the more this company should go up, or maybe this one should blow up, or maybe this one has a contract with this one and so that's gonna make it go crazy. So now you have 100 holdings in your portfolio and it's overwhelming. Or you go the other route. You start investing and you wanna go incredibly simple. You hear that the data suggests that one could just invest in something like the S&P 500 fully and be done with it, set and forget it and let it compound. But inevitably, in either situation, it leads to the question, what's the most optimal portfolio? Like, how many holdings is the best way to invest? Well, not only do I have the academic data and knowledge from studying and backtesting and teaching as an actual university professor, but also I work with very wealthy clients who have done this, and I've worked with over 1,000 of them to date. So I see what actually works best, and so I have some great data for you. My name is Nolan Gobea. My students call me Professor G, and I made this channel to make investing simplified. Remember that all investing carries risks, so do your own research. This is not financial advice, and I'm not a financial advisor. Now, first and foremost, we need to eliminate one of the scenarios that I just talked about. It's been very documented and well researched that it's almost impossible to beat the market. Even professional stock pickers and professional Wall Street traders lost to the S&P 500 over time. They could win 1 or 2 years, but over 5 and definitely over 10 years, more than 95% fail. There's a famous bet that Warren Buffett did a while back where he said that a monkey could throw a dart at 50 companies in the S&P 500 and that portfolio would do better than most professional financial advisors and actively managed hedge funds. He then took it further. To prove his point, Buffett made a real $1 million bet in 2007 against asset manager Protégé Partners. On Buffett's side, he said he would just have a simple investment in a Vanguard S&P 500 index fund. On Protégé's side, they would have a basket of 5 actively managed funds of hedge funds. The result, over the 10-year period from 2008 to 2017, Buffett's index fund returned an average of 7.1% compounded annually, while the hedge funds averaged a return of only 2.2%. So the first thing to throw out would just be that I personally would never suggest that a person's portfolio should be the vast majority individual stocks. I do think that within the portfolio, a couple of choice stocks does make sense, and we'll get into that in a second. But first and foremost, I do believe that the vast majority of one's portfolio should be in low-cost, broad ETFs. When helping clients, I like to see 80% or more of the portfolio in ETFs or index funds with 20% or less of the portfolio in individual stocks. So since the portfolio should be majority ETFs, let's actually talk about the smaller section first. Let's talk about the individual stocks if that's what you choose to have in your portfolio. Then I'll give you the exact categories for ETFs. For individual stocks, these need to be companies that you research like crazy. Not only to buy them, but also understanding when do you sell them. Understand not only the company, but also their competitors and their customers. Said differently, you should know everything there is to know about this company because you're about to stick your hard-earned money into their care. Stocks are much more volatile than ETFs. If the whole stock market goes down about 5 or 10%, a certain stock market could go down 40 or 50% in a flash. My advice to you is something similar to what Warren Buffett has said many times. Only buy a certain individual stock after much research and with the intent of holding long term. Like, not like a year, like 20 years. Buy slowly. My suggestion is that people have as little as 0 individual stocks and only as much as like 10 total individual stocks. I've found that a very solid number is 3 to 5 if possible. But honestly, if you choose 0 as your number of stock holdings, that's actually a pretty wise decision. Now this video is all about the specific number of stocks and ETFs that one should have in their portfolio, but no matter what you choose, there's only one platform that I recommend to track everything. Thank you to Snowball Analytics for sponsoring this video. My private Patreon members always ask what's the best platform to keep track of everything. And honestly, I haven't found anything that keeps you organized like Snowball Analytics. Analytics. This dashboard has everything in one place, telling you your value, profit, return, and most importantly, your passive income through dividends. You can check the portfolio diversification easily here, and my favorite feature on the dashboard is the dividend tab, where you can easily see all your insights, which assets paying and how much, and exactly when you can easily forecast and stay on track. Very easily you can check on the dividends coming up because they have a great dividend payout calendar. And now this new X-ray feature has been amazing for my clients. This lets you know how much of an actual company you have exposure to. Like here, if you have Vu and Jeppy as top holdings and want to know actually which companies you hold most, you click the X-ray Funds tab and now it tells you which individual holdings are heaviest in your portfolio. Another awesome feature on Snowball Analytics is the Community tab, where you can stay up to date with awesome blogs, even public portfolios for you to research and learn. Go down to the link down in my description to check out Snowball Analytics today. Alright, so we first discussed individual stock holdings, and now let's talk about ETFs. You have to remember that an ETF in and of itself is going to be a basket of stocks. Any solid broad ETF will have at least 100 stocks, but sometimes thousands of stocks in one ETF. You need to understand that one broad-based ETF is already way more diversified than just picking 50 individual stocks. It doesn't seem like it since it's just one line item in your portfolio, but it's absolutely already more diversified than many investors ever were back in the day before ETFs. Like back in the day when they encouraged a diversified portfolio, what they were talking about was they were hoping that somebody had about 30 to 50 different types of stocks, and that would be well diversified. So nowadays, you absolutely could invest in just the S&P 500, one item, and be totally good with it. 500 different companies from 11 different sectors, average appreciation at around 11% per year. Super simple, super effective, and has come back from any big market crash. The problem when you invest that simply into just one holding though is you're kind of at the mercy of whatever the market average is doing. If the market's going down, then your portfolio is going to go down. If the market's going up, you're going to get that appreciation, but you're not going to beat it. If you want that super simplicity, great. There's your portfolio, one holding, VU or SPY-M, boom, you're done. But if you want a bit more control and you want different levers to pull based off of different goals, you may want to consider adding in more ETFs in there. You may want an ETF for dividends or passive income. You may want an ETF that has exposure outside the United States just in case. You may want an ETF that has a higher concentration of technology or growth companies to hopefully capture more upside, even though there is more risk. And then within that, maybe you want even more upside with an ETF that's all technology to really supercharge the portfolio. So in this event, the first thing that you're going to want to do is go check out this free tool at etfrc.com that shows you fund overlap. The problem that I see in many people's portfolios is that people have something like 10, maybe 15 ETFs, but really they could consolidate it down to maybe 3, 4 ETFs because there's so much fund overlap, they're actually investing in the same thing in 2 or 3 different places. Like XLK is a great ETF that invests in technology companies. In the past 10 years, it's up over 22% on average each year. VGT is a great ETF that invests in technology too, but in a slightly different way. This one has been crushing it too, and it's been averaging 22.5% per year in the past 10 years. VGT has 322 stocks in the fund, where XLK has 69. So it would seem smart to diversify by having both. But then when you go to etfrc.com, you can see here, there's a 78% fund overlap, and literally 100% of the stocks in XLK are already found in VGT. So owning both is just redundant. So figure out the core categories that you'd like to be invested in within the portfolio, and then just choose 1, maybe 2 total ETFs for each category. A couple good categories could be foundational, value/dividend, broad growth, technology/AI, international, bonds, commodities/gold, cryptocurrency/Bitcoin, and real estate/REITs. A very solid portfolio would have 3 to 4 ETF categories picked out that makes up 80% of the portfolio, and have 3 to 5 individual companies heavily researched and picked out that make up the final 20% of the fund. Now make sure that your individual stocks that you chose don't overinflate the portfolio and put you at risk. For example, if you have a foundational ETF like VU at 30% of the portfolio, and then a dividend ETF like SCHD at 25% of the portfolio, and then a technology ETF like VGT at 25% of the portfolio, that seems pretty balanced. But then if your 3 stocks you chose to hold are Meta, Palantir, and Nvidia, now you actually have overweighted the portfolio big time into purely technology, so the risk is much higher. Try to have a couple of individual stocks in differing sectors so that you can spread out the risk and diversify more. I just updated my 3-fund portfolio and show exactly how I'm investing in 2026 in this video here, with actual funds and actual percentages based on your age and based on your goals. So check that out right now, or watch this one to keep you going strong in investing. Remember to keep investing simplified.